to everyone. So we have introduced training before, but now we plan to do this every Wednesday of the month, starting the first Wednesday of the month. So the point here is we have segregated this derivatives training into two parts. One would be a basic one. A basic derivative training would teach about the concepts of derivatives, how to use them in the real market, and how to look into things which helps client introduce them more towards a trade into the derivatives, and obviously to the dealers and the participants in this market. Now, this is very necessary because we know that close to 80 to 90% of the volumes right now is happening more into the equity derivatives, and options plays an important role. So if you say index option, even that would contribute to almost 80-85%. So there would be a lot of concepts, but we have tried to focus on those things which will actually help more in the practical trade, and obviously which would cover into the dynamics of derivative as well. So this training would basically be into two parts. So let's say the first 30 to 40 minutes we'll try and introduce a lot of concept, give some practical aspects to that. So if you have a pen and paper ready, because there are a lot of constants in derivatives which need not be calculated or harnessed, that can be simply written and followed, so that works a lot. So that would be the first thing, and then we might have a question and answer session maybe in the last 15 minutes just to discuss what exactly we learned or we discussed today in this training. So starting with this, as I said, this would be a very basic one. So the first introduction to derivatives, that obviously when all the dealers here and the people here have cleared their NISM, that is exactly a mandatory norm. So this is more or less the terms that everyone is quite knowledgeable and they know what it means, but then I'll just run through that. So basically you can divide derivatives into two major instruments. The reason I'm saying instrument is obviously because when you put in your trade, or the margin or the money involved divides it into two categories. So first would be your futures and second would be options. Now futures trade, simply saying, is as good as buying the cash market underlying, but then the only difference majorly here is we buy in a lot size, because that's like a like a lot which is calculated by the NSE, which is there for every underlying, and obviously we end up buying just a margin of it. So generally 20 to 25% of the value, let's say a stock of 100 rupees and the lot size of 100 odd. So even if it has got a value of 10,000 odd with a 25%, say around 2,500, you can enter into a trade, and we all know there is an M2M which follows. Now we would be more interested in this part because this happens to be the major volume driver. So the second instrument, which obviously gives a better risk reward, would be options. The category is simple. When if you feel the scenario for the underlying is on the bullish side, or if you expect an up move in the option, then you focus more on the call options. You try to do some strategies or get involved with the call option types. And when you feel that there is a necessary to hedge or maybe get into a bearish mode on any underlying, be it index or stock, you try to get into the put option. Now obviously there are two things to any option: either you can be a buyer of option or you can be a seller of option. So that goes for both. So based on that, we'll actually identify on which stage of analysis should we enter into either of these four options. So as I said, the first thing is derivatives has an underlying. So in case generally when we talk about index, it's your Nifty and Bank Nifty. Yes, there is Fin Nifty as well and NSE but Fin Nifty, obviously the open interest is less. I guess it's not more than 6,000 odd. So the first most important aspect in any derivative instrument is liquidity. As I said, it happens in a lot size. So even if you're right on the trade, and if you cannot get an exit, it is as good as going wrong on the trade. So the first parameter for any derivative instrument should be liquidity. So what NSE has is, for NSE, the impact cost or the liquidity is so high that even if you end up buying a 75 lakhs worth of Nifty futures buy and sell, the impact cost would be not more than a 50 to 75 paise. Simply saying that is the amount of buyer and seller which are there in the this instrument. So underlying is the cash entity, or the entity of which this option, which the two instrument, which is your futures and option, which we discussed in the previous slide, is generated. So for if it is a stock, then obviously it goes as a stock future and stock option. If it goes as index, which I said there's Nifty Bank Nifty primarily, so that would go as a Nifty future and a Nifty option. Then that the Bank Nifty underlying would go as a Bank Nifty future and option. Now the good thing is it's almost 3 to 4 years that we have this weekly expiry being introduced on every Thursday. Primarily, it used to be the last Thursday of the month. So now, since the advent of this weekly expiry, so a lot of opportunities for both the sellers of option and the buyers also come in. So that makes it a much tradable, sorry, and a much liquid market, and that has given rise to this massive volume that is happening in the index. So we need to be a part of that understanding to get into that volume share also that the market is currently doing. It is not, this is precisely for equity, but then obviously the the options and future instrument goes in for any underlying. It can be a commodity, it can be a currency, or it can be bonds. So just like the examples that we have mentioned. So this is a simple slide wherein it says that, like, say we have taken a stock here, SBI, with the current market price of 600. So if we have a derivative positive view on the stock, we end up buying December futures at any point of time. There are 3 futures available. One is CM, which is called as the current month. The second is NM, which is called as the next month, and the third is FM, which is called the far month. So the contract which is going on right now as per the expiry. So in this case, we are in the December contract. The expiry is on 29th of December, which happens to be the last Thursday of this month. So we have December, Jan, and Feb, these 3 contracts of futures available for the index and stock. Now, obviously, for the option, it's much more. We have more options on that. So if you see, there is a concept called as LEAPS, which is long-term equity and anticipated option. So we do not really use it. But then, yes, that is an instrument that will be used further as we come up with more products on the index as well. So LEAPS will give you a good coverage for the underlying till 1 year. So generally we have 1 to 3 years, but the 2 years or the 1 year and beyond LEAPS, the options are not really liquid. So generally the common months, which is March, September, and December. Now this happens to be the calendar months as well, and the financial half year as well. So this would be the months where these LEAPS are liquid. So let's say the end of 2022 on December, we have a 2023, which is a 12 months or a 1 year ahead December option also active. So that qualifies into the LEAPS. Generally, we look into a weekly or a monthly, but then this is just for your knowledge that we should understand it is also there, and we can be doing a lot of it. Depending on very niche clients, there are clients who need long-term view along with some portfolio. We'll come to that later on, but this would be one type of option that we should be aware of. So now coming to the simple category as to what exactly is an option. Now there are a lot of definitions that an option gives a buyer a right to underline an asset and all, but to simply say, if I have to simply put it, let's say in an analytical way, if you're traveling from a destination, let's say from A to B, and there are 2 to 3 stops in between, like an A1, A2, A3 till A5. Let's say you're going from A1 to A5, and if you have not entered the trend, or maybe let's say the journey at A, you have an option to get into an A1. Obviously, the probability of your success would be less because you're leaving that part of distance. So option simply gives you different intervals at which you can enter the trade. Obviously, the direction of the trade will depend, like I previously said, should you be going for a call option in case you have a bullish or a positive bias, and likewise a put option if you have a bearish bias. So I guess we have English and Hindi as well. So I'll just put in some with the Hindi text as well. So option simply जो डायरेक्शन मार्केट में क्लाइंट्स या जो ट्रेडर ने लिया है उसके हिसाब से, लाइक अगर आपको तेजी करना हो तो ऑब्वियसली आप कॉल ऑप्शन में ज़्यादा प्रेफर करते हैं, एंड इफ इट इज द मंदी साइड, अगर बेरिशनेस होगा तो भी पुट ऑप्शन पे ट्रेड करते हैं. So what exactly is a call option? We all know that now, obviously, because there are a lot of trades given, but the basics to a call option is that is the amount of premium. Let's say there is certain amount of premium at 20, 30, 50 odd rupees on every strike that you end up paying to get into that journey from that A to B. So let's say if you have a positive bias on a stock, let's say stock is trading at 100 rupees and you expect that stock to go to 120. Now there are two things to that. One is either you buy in the cash market, take the delivery and sit for a target of 120. Second is either you buy a futures. Obviously now, as I said, you will have December futures, Jan futures and Feb futures. So either you buy the futures at 100 rupees. Now obviously futures happens in a lot size. So there is an M2M if it goes on the downside because the bias is buy. So the loss is on the opposite side. So you either trade it with a stop loss or you hold it till the target of 120. The third and the most profitable or easier way. Now, obviously, when I say the easier or the profitable, it has equal risk and reward. So because in the market, the basics of market is nothing. There is no reward if there is no risk to your trade. So the third option would be a call option. Let's say now the journey is from 100 to 120. So there are different strikes. Let's say at 5 interval of 5. So 100, 105, 110, 115, 120. So a 100 call option for month in December, let's say, would be around 14 rupees. And when you go to 105, that might come down to 11 rupees. When you go to 110, that might be 7 rupees and so on. So what happens is the strike at which you decide to enter, let's say you buy a 110 strike at 7 rupees and the stock goes from 110 to 120. So the level at which you entered the trade using instrument of an option was 110, which is called as a strike price. We all know that. And the target was 120. So you end up making an intrinsic move on the underlying by 10, but because you have paid a premium of 7 odd rupees, you end up making only 3 rupees. So we'll have more things detailed on that, but primarily call option would be used to trade the underlying on the positive side, on the bullish side, and likewise, if it is on the bearish side, we use put options. So as I said, now this is a bit important wherein we need to understand where exactly we end up being a buyer of option and seller of option. Now, obviously, the textbook and even your NISM clearly says that when you sell an option, the risk is unlimited because when you sell any option, the level at which you sell is the maximum profit and which can come to zero. So let's say if you sell a call or a put option at 20 odd rupees, so you end up making a maximum profit of 20 rupees minus your brokerage and charges. So that can be a maximum profit. And when you are a buyer of an option, you buy the option at 20 rupees. The maximum risk can be zero because the option can go to zero if things don't work like you plan. And the upside, it can go to any 20, 40, 60, 80, 200, or maybe 250 or even 500 at times. So the upside is limited, is unlimited. Now, this all looks good, obviously from the theory part, but practically what happens is, let's say I will be using a lot of Nifty here because I guess if this training revolves around Nifty and Bank Nifty, that would be prima facie where the volumes are attracted and that helps us understand. Now, if you see Nifty also on a weekly basis, the swing or the movement in the Nifty is around 380 to 400 odd points. So let's say we are at 18,000 on Nifty and an 18,200 call option is 50 rupees. So now you will statistically think that, oh, Nifty moves around 400 odd points. So an 18,000 might be, again, I'm using the word might, it's not really can, because when you use an analysis, there is certain permutation on the implications of the underlying it might happen. So if you're expecting that 400 points and you have entered the trade 18,200, you end up making 200 rupees. And whatever premium, let's say you end up making, you have paid a premium of 50 rupees, the target or the profit that you can have would be 150 rupees. Now, this is true only when the Nifty moves from 18,000 to 18,400 in the 5 days. That is on a weekly expiry, we have Friday. Then we have 2 holidays where the option premium comes down. Then you have a Monday, Tuesday, Wednesday, and the day of expiry. So if you see, if I simply say the chances of the Nifty to move 400 points in a linear way, what I mean by linear is every day it accumulates or goes cumulative on one side. The chances are not more than 15%, 1.5. So let's say of every 100 times you end up buying an 18,200 call option with the bias that the Nifty will go to 18,400, 15%, 1.5, 15% chances are there that you will actually see the Nifty going 18,400 and making money. Now, the thing here is, obviously, statistically, if that is a way of making money, we can do it. But then patience runs out and we never end up buying always. So that is when the 85% of chance where it does not make this move in a linear way comes in, which is called as a seller of an option. So what happens is, yes, there is risk to that. So a seller of an option might sell the 18,200 strike call option for 50 rupees, but then he understands that there is 4 days to expiry. So he simply divides 50 by 4, and let's say that 10 to 12 odd rupees per day is the net profit that he would want to take in. And as I mentioned, let's say the trade is done on a Friday, then we have 2 offs, that is Saturday, Sunday, and on Monday he ends up making a good 10 to 15 odd rupees on that sell premium. So this is exactly the product that we have, which is theta DK. So obviously it is not as simple as to just sell an option and take in money, but we look at a certain parameter. So the risk reward, a simple way, now using your pen and paper, as I said, there are certain constants. So the simple understanding is, when your volatility index VIX is below 17%, it makes profitable to be a seller of option. Now I understand there is a concept that when the VIX is high, you get higher premium, but now because we are entering into the new niche way of understanding when should I sell an option, let's go with this. Once we are quite well versed with this concept, then we might go to a high selling option for VIX beyond 17. So the first rule you understand, or you try to see, is when till the time the VIX is below 17% for Nifty, obviously the VIX is for Nifty, selling an option makes selling an out of the money call option. Now when I said out of the money, that would be 400 odd points, makes sense. Now this this entire calculation comes simply from the statistical move. So buying an option would be done when you expect that the move might come. That can be for an event, for a movement, for an underlying, and the selling of the option might come if you feel that it's a weekend, or we expect that the movement might not be there, or the option premium started decaying. Generally, if you see, there is a calendar spread strategy even today that we give. So we generally give it around Tuesday, but today we were waiting for the RBR policy to see the direction, and that is where we given a calendar spread. So calendar spread is a mix of both the buy and sell option. So as we eventually go further into this training, I'll explain as to what exactly can be used. Same goes for the downside. If you're bearish on the market, you either end up buying a put option, but when you're hedging in your position, you simply buy the put option. You are not really worried about the time, because the bigger motto of buying a put option is to save the portfolio or the underlying, which is going against the market trend. The cash market always makes profit on the upside. So obviously the opposite direction on the downside is where the put option necessarily tries to give you some money from the multiplier the option has when the market goes down. Now, these are just examples that we've given, that let's say the Nifty is at 18,600 and if the strike is 18,500. So like the previous example that I said, if you're going from A1, A2, A3, A4, A5, and the journey is from A1 to A5, if you are at A1 and the market is at A2, let's say, so 18,600 is where the market is, and the strike is 100 points in the money, because from 18,500, when you move 100 points ahead, that is when you come to where the market is. So this is called in the money. It is in the money by 100 points. So that is a concept of call option. If the Nifty is trading at 18,600 and you're thinking on an optimistic scenario and buying an A2 or an A3 in this example, which I said, then the strike would be 18,700, which becomes out of the money. And third would be at the money. So the simple thing is, wherever the Nifty is trading, the Nifty spot, wherever the Nifty spot is trading, the options near to that spot are termed as at the money. If it is a call option and if it is below the market price, then it is called in the money option. If it is a put option and if it is above the market price, that is called a in the money put option. So a call option is always below the market price. In the money call option is always below the market price, and in the money put option is always above the market price. So this is the simple crux that we understand this. This is an important slide. Almost 60% of the derivative works on this concept, but this obviously it looks simple, but then there are certain maths to that which has to be applied. So any underlying in the index, be it Nifty futures, Nifty options, if you see the price going up, now what do you mean the price going up? If you are a positional trader, you will see day to day, that is, you will see the price today. Let's say today is 18,000 and you will see what is the closing tomorrow. If the close is 18,020, then you will say, okay, the price has gone up by 20 odd points. If you are intraday trader, you will look at, let's say, 1 hour moment. At 10:15, you watch the Nifty is at 18,000, and at 11:15, you see, okay, the Nifty is at 18,020. So then you say, the Nifty is up. So time intervals are decided as per what the risk or the character of the trade is. So in any scenario, when you fix the time frame and when you see the price increase, and then you look at the open interest, obviously we all know that in even on your Odin or when you press the key F5 on the underlying, it opens up a window on the right hand side down. If you see just below ATP, there is a OI and a percentage OI thing. So OI stands for open interest. So if you see the open interest increases by irrespective of any amount, but if it increases, let's say the Nifty increases by 20 points and the open interest also increased by 2%, then the implication of this data, that is what does this data say, is there is buying or a long built up. So what do you mean by long built up is long means positive position or bullish positions which are being built up. The second thing is if the underlying is coming down, let's say the Nifty is 18,000 and it's come down to almost 20 odd points, but the open interest is going up, then you say it's short built up. So guys, if you see, the concept of open interest is very clear. Open interest, I would simply define as a term in which the interest is open of a trader. If your trader has a position in the market, his interest is still there to make the money. So an open interest signifies the amount of position that is actively there in the market, which is open. So, and even on the bearish side or the bullish side, the major criteria, the open interest has to go up, because when the participation goes up, either on the bullish or the bearish side, that is where the underlying, that is the Nifty, goes up or falls. So increase in open interest is the first most priority that should be seen in a data, especially your derivative side. So the first scenario is when the price goes up and the open interest goes up, we anticipate that yes, it is buying. That is exactly why the price went up. The second scenario is when the price goes down and the open interest goes up, then we imply this as a short buildup, because when people are selling, that is why the price is coming down, and because people are holding on to that position, the open interest is going up. The interest in that sell trade is still there, so that is why the open interest goes up. The third scenario is when people feel that when the traders feel that okay, now the short positions need to be squared off. So what do? You square off your short position by buying back that Nifty future or Bank Nifty future. So when you buy anything, the price comes up, but then because you have closed your trade, you do not have any interest in the trade because your trade is squared off, then the open interest comes down, so which is called as short covering. And then the fourth side, you simply takes profit out, and when the price is going up, when the price is there and you keep on selling, say that we need to exit this trade, so the price comes down because you're exiting by selling, and there is no interest in the trade because you have squared off your position, so that is long unwinding. So these are the four basic crux which can be used on an option, which can be used in a future, and which can be used on other underlying as well, your currency, your commodity. So, but obviously there are certain match to that. This is just the basic as to what implication does a derivative give. So as if you see, there is an example mentioned wherein a rise in the open interest along with the increase in the price goes up. So for an example, if PNB if the price goes up by 1% and the open interest has increased by 20% on 6th, so this happened actually. So the implication there is that PNB is in long built up. Same goes with HUL. HUL, obviously in the FMCG sector, even yesterday, the price was up by 1.5% almost, and the wire came up. So that's an implication there is long built up. Now, same goes with the short built up and long unwinding. These are just examples that we have given. The important aspect I would like to cover would be short covering. Now, this is an interesting thing. Just note down one more thing. I guess let me put it one more thing. What do you do in all the four scenarios? When the price is going up, open interest is going on. When there is long built up, you buy a call option. It can be at the money or just out of the money. So generally, buying a call option is more profitable when the open interest in the price, when the long built up is there. What happens in a short built up? When there is short built up, you buy a put option. You either buy an at the money or just out of the money put option. Now, obviously, the first scenario for a put, or when you are buying an option, you need the underlying to move, which is your Nifty. So when there is open interest going up, that means the people are positioning their trade in the futures. So irrespective if it is futures or option, the Nifty spot has to move. That is exactly why you will be buying a put option when there is short built up. The third and fourth are the most important. We need to understand the third and fourth scenarios when you sell the option. What do you do that? So when there is short covering, that means the short positions are being squared off. Now, when you square off a short position, that means you are expecting the support is being taken or there might be an upside, but obviously you do not expect it to go up. So selling out of the money put options is a strategy which should be done during short covering. That is when you expect, let's say for example, the Nifty was at 18,000, it came down to 17,900. You saw the short build up happening, but then the open interest started reducing and the Nifty again went back to 18,000. So you would say that the first 100 points is where the fresh shorts came in, where you should be a buyer of put option. The second scenario from 17,900 to 18,000 is where the price went up. The third scenario you see, and the open interest shed. So this is a scenario where you should be selling an out of the money put option. This is simply what to say, very simple crux as to understanding when, as I said in the first slide, we'll be discussing when you should be a buyer and seller. The third is when there is profit booking in the market, like what happened today. If you see post the RBI policy, I guess the first 2 hours, Nifty was more or less 18,700, 750 odd. But then every time it was going to that level, we are seeing profit booking. It came down 50 odd points, 40 odd points. In the last 1 hour, it actually broke the support as well. So when you see such long unwinding happening, selling out of the money call option is a scenario to do. So this is the most important slide I would say in this training. So when you see the price going up of the underlying, we'll take Nifty futures. And let's say when the price of Nifty futures goes up, the open interest goes up, it's a long built up. The best trade to do in terms of risk reward would be to buy at the money call option. When the price goes down, that is Nifty goes down, Nifty futures rather, and the open interest goes up, the best, which is called as a short build up, the better strategy would be to buy at the money put option. The third scenario is when you're seeing the Nifty bounce and the open interest is coming down. So short covering is an implication. So you would sell out of the money call option. Let's say the Nifty has bounced from 17,900. So you'll be selling a 17,800 put option and below strikes. And on the fourth side, when you see the Nifty is coming down and the open interest is also coming down, let's say Nifty comes down from 18,000 to 17,900 and so on. So you start selling an 18,100 and above call option. So this would be the four scenarios, wherein two scenarios tells you to buy the option and two scenarios tells you to sell the option. So obviously, if you see when the participation decreases in the direction, that is where you need to sell an opposite option. But when the participation increases in the direction, that is when you need to be in the same direction of the trade. That is, if it is on the upside, it's a call option. If it's on the downside, you're a buyer of the put option. Conversely, when it is on the upside, you become a seller of the put option, and on the flip side, when it is going down, you become a seller of the call option. So this would be the four more criteria which can help even in the trades and clients. So let's say we put a scenario where a client comes in and says that a stock of 1,000 odd, and you are seeing the price has come down by 2% and the open interest has gone up by 3 to 5%. And if the client insists that, or maybe the client asks, is it a good time to buy a call option? So you would certainly say no. The reason is because it comes into the second criteria, which is the price is going down and the open interest is increasing. So you would say it's a rather short filter. So let's say we can buy at the money put option because that has more probability to give you money. Or you can still maybe ask him to sell out of the money call option if he's ready or if he has more margin on that. So this would be the four most important scenarios that should be done, can be done rather. Now, based on the open interest, net open interest of option that we have on the Nifty, we have 2 to 3 scenarios which can be done. Now, these are also constant. We can simply write it. The first four most important is wherever the market is. If you open the NSE, you can see the color change on the option chain. So you need to select the same strike, let's say 18,500, and you look into the total open interest of the call side, and you look into the total open interest of the same strike put 18,500. If the call is 2 lakhs and the put is 1 lakh, then you would say that the call open interest is twice that of put open interest. So that can be a scenario where you might feel that 18,500 plus the premium of call option, this can be the resistance of the market. I'll repeat that. So when you see the open interest of call option is twice that of open interest of a put option for the same strike, same expiry, it can be assumed that that strike might act as a resistance till that weekly expiry. On the flip side, if you see the put option net total open interest being twice that of a call option for the same strike, same expiry, you can assume that that strike might be the support for the market till expiry. Now this is exactly, if you remember today's trade, 18,600 strike. The put options were a good I guess 18 to 20 odd lakhs where we had seen that writing, and the call option was not much. But then I guess after the Europe Open, the put writers went away and the bias was more on the call selling. So we actually saw the call open interest go up and the market made a new low. So in the morning when the policy was going on, the put open interest was almost twice as the call open interest. So every time the Nifty was correcting 50 points, the market was bouncing from that because of the put writing, and that is exactly why we had an intraday call as well. So these are the simple scenarios as to it. So the underlying here is when the option of the same strike, if it is call, becomes twice that of put, it's a resistance. And the flip side, if you see the put option open interest being twice that of a call, then that scenario might become a support. Now the reason why I'm using the word might here is obviously one strike and maybe some 20, 50, or maybe a 70, 80,000 strike call option and put option cannot decide where such a big index of India, which is your Nifty, can take a support or resistance. But yes, this is one of the parameters which can be used. So we need to understand this is, even if it's a stock, we can still vouch for it. But when it is index, there are a lot of other parameters which comes into it. So this can be one. So put call ratio, what is put call ratio? Is simply divide the put by the call. So let's say the put has got 2 lakh open interest and you divide it by the call open interest of 1 lakh. So you get 2 divided by 1, the answer is 2. So when the put call ratio is 2, that is when generally you have seen that there is heavy put writing that has happened. This is for the strike. Generally, what happens is for the entire market, there is a scenario wherein people get complacent selling a lot of put option at every fall. This happened even on the Nifty, I guess, last 3-4 days. There were a lot of complacency. The VIX came down and a lot of put writing is happening. So when your PCR actually goes to 1.5 and above, that means you see almost 1.5 times the put options are being sold to every call option. That means there is complacencies coming, and people are not really expecting the market to correct. So that is generally when it tops up. Same goes on the opposite side when you see that twice the call option is being sold to the put option. That is, there is too much bearishness. Generally, this is the entire strikes I'm saying. This is not the one particular strike that we're talking about. The entire scenario of Nifty for that weekly expiry, then generally the market takes a bottom. So intraday basis, I guess, looking at the same strike, call and put option would be a much better scenario when you're looking for a positional view, maybe a 3 to 5 odd days. That is when you need to see the entire scenario, wherein you would say 1.5 is an oversold and 0.5 would be an overbought and 0.5 would be an oversold, where you expect the market to bounce. Now, most important is the implied volatility or the underlying, which is VIX, has a big share in an option price. Generally, an out of the money option, a good 60-65% is because of the IVs, the implied volatility. So if you club this match, the 2:1, which I were talking, along with VIX. So if you see the VIX coming down and the put open interest is twice that of call. So, the VIX is generally down when there is selling of options. So you can say that yes, because the activity is happening in put, and that is exactly why the open interest, remember the term open interest, that the interest is still open. So there are put writers and the VIX is coming down. So you can assume it is selling. So the support in the market is possible. Same happens on the flip side. If you see the call net open interest being twice that of a put in the same strike and the VIX is down, you can assume that maybe there is call writing and this might act as a resistance. So combine your put call ratio, same strike along with VIX, and this works most importantly for at the money. The reason is VIX has a calculation. It's a bit complicated one, but if you see almost 67% of that, so let's say the VIX is at 14%. 67% of that 14% comes from this at the money strikes. There are certain parameters they use. So you can almost be right there. So when you see VIX falling along with the put call ratio, like we mentioned, we can safely assume that it is selling of option. So this would be the second important slide. So guys, these are the four basic thing or the major thing that we said. So first is, I would say this slide wherein the open interest we are talking about, as to what scenario you would be asking the client for the stock or index to be buying, and this would be the put call ratio when you see it for the same strike along with the VIX falling, where you can assume this would be a buying or setting of option. Now this is a bit basic, obviously, because there are a lot of terms we expect people to be well versed with. Once we are through this, then maybe that gives us a better grip as to where we can take it. We can open the floor for Q&A, Swaraj, if you're there now. I guess we have one from Supriya saying that option indicator, and she's put a question mark. Okay. So
I'm very much there.
yes, Swaraj. So Hindi, please. So more or less, yeah, we try to put in Hindi. So at least if there are any queries on this part.
So team,
guys,
if you have any questions,
yes.
request you to raise your hand or simply type your questions in the Q&A section so that Manoj can address those queries right away, right now for you.
Right.
So we have got Kapil Bode. Okay, Kapil, request you to unmute yourself and ask your question, please. Kapil, you may ask your question.
Hello, sir. Namaskar.
Namaskar.
This lecture was very fast. I don't understand very something.
So
This is very speedy lecture.
तो कपिल जी एक्चुअली क्या है, क्योंकि डेरिवेटिव में काफी सारे कॉन्सेप्ट्स है, बट देन थोड़ा बहुत मैं सिंपली आपको हिंदी में आई जस्ट गो थ्रू दैट फॉर इन हिंदी फॉर 2 to 3 मिनट. इसमें आप देख लो, मैं मेजरली जो बता रहा था मैं ये था कि जब भी जो भी अंडरलाइंग होता है, अभी यहाँ पे मैंने प्राइमरली निफ्टी के बारे में बोला है. तो अगर निफ्टी का प्राइस ऊपर जाता है और ओपन इंटरेस्ट आप ओडिन में भी होगा तो F5 करोगे तो आपको एक बॉक्स खुलता है जिसमें आपको राइट हैंड साइड नीचे में ओपन इंटरेस्ट दिखता है. तो कोई भी अंडरलाइन जिसका प्राइस ऊपर जाता है और ओपन इंटरेस्ट ऊपर जाता है, उसका मतलब उसमें तेजी के पोजीशन बने जिसको लॉन्ग कहते हैं. ये जो फर्स्ट सिनेरियो अगर आप देखो, ये जो स्क्रीन आपके पीसी या सेल में होगा. द सेकंड सिनेरियो जब भी निफ्टी नीचे या यहाँ पे मैं सिर्फ निफ्टी का एग्जांपल ले रहा हूँ, जबकि ये बाकी सारे अंडरलाइन के लिए भी चलता है. तो निफ्टी अगर नीचे आ रहा हो और ओपन इंटरेस्ट बढ़ रहा हो तो उसका मतलब उसमें शॉर्ट बिल्डअप है. शॉर्ट बिल्डअप का मतलब है मंदी के सौदे हो रहे हैं. तो ये दो सौदे जहाँ पे तेजी या मंदी होता है, वहां पे आपको कॉल और पुट ऑप्शन के लॉन्ग बाय ट्रेड पे जाना चाहिए. और बाकी जो सिनेरियो है जहाँ पे प्राइस ऊपर जाता है और ओपन इंटरेस्ट कम हो जाता है, तो वहां पे आपको शॉर्ट कवरिंग और लॉन्ग अनवाइंडिंग. तो ये थोड़ा एक आध ट्रेनिंग में आप बैठ के इफ यू ये अटेंड होने के बाद ही ये कॉन्सेप्ट क्लियर हो जाएगा. बट आपको इतना समझना है कि डेरिवेटिव में एक चीज होता है, जहां पे भी ओपन इंटरेस्ट बढ़ता है वहां पे उस डायरेक्शन का सौदा और होते जा रहा है. जैसे अगर मार्केट गिर रहा है या निफ्टी गिर रहा है, ओपन इंटरेस्ट बढ़ रहा है, यानी वो मंदी का सौदा हो रहा है. एंड ऑन द फ्लिप साइड अगर मार्केट बढ़ रहा है या निफ्टी बढ़ रहा है और ओपन इंटरेस्ट बढ़ रहा है, तो तेजी का सौदा हो रहा है. तो आपको ये बेसिक क्राइटेरिया लेके आगे डेरिवेटिव का अजम्पशन करना है.
Okay. Thank you, sir.
Right. Thank you, Kapil ji. Thank you for asking a question. Next, we have Mr. Benjamin Robert. Mr. Benjamin, I request you to unmute yourself and ask your question. Mr. Benjamin Robert.
Yeah, please unmute yourself.
Mr. Benjamin Robert, you can simply unmute yourself and ask your question. I hope I'm audible.
Achha, Benjamin says the session was too fast to grasp. I understand, Benjamin, but then we will have such sessions on every Wednesday of first Wednesday of the month. The thing is, because there is at least some meat which has to go in to understand as to where the difference can come in. So of all the slides, I said this would be the most important one, where you can see on the background which says price and open interest implication. This would be the most important, followed by this scenario where it's a put call ratio. So these two slides, just understand these two concepts, the rest will follow in, because obviously when you try to make a successful trade, the rest of the things will have to come in to understand this concept. So of the 10 or 12 slides that we have, this table, this 4 to 5 lines of table is actually the crux of entire thing. So just focus on this.
Right. So team, any other questions so far, so forth? Any other questions? So Manoj, no more questions so far.
Okay, so guys, this will be happening, as I said, every first Wednesday of the month. So try to attend it as much as possible, because this concept will not rampantly get into, but we need to understand. And the good part is, let me tell you, this is I would not be taking the theoretical part, because this is not an NISM exam. This is for your understanding, because you grew up more into derivatives, to understand the risk reward of the trades that we're giving. So yes, I understand it might be a bit fast, but then when we go repetitive on the same analysis, there is like more or less an advanced version also, which will come later in. So once we are well versed with that, we'll go to the second level. But as of now, this is what we need to understand, and we'll take it from there. Yes, Suraj, if you can.
Right. So I believe no more questions so far, so forth. So with this, we can conclude the session. I would like to thank Manoj. Thanks all the
Yes,
participants for joining with us. So with this note, we are concluding the session. Thank you. Thank you once again. See you again first week of next month with advanced